Welcome back to the trading floor. I'm David Axtell. Episode 16, the final episode in part 4. And after 3 episodes on swap structure, funding mechanics, and central bank operations, I want to bring it all down to earth. Because ultimately, this is about one thing: keeping the lights on, liquidity management, making sure you can meet every payment obligation in every currency on every day, without fail, without surprise, without panic. Sounds simple, it isn't. Let me describe what a typical day looks like for a bank treasurer managing multi-currency liquidity. 6 a.m. London time. The Asian markets are closing. Your Hong Kong branch has a dollar surplus from overnight settlements. Your Singapore branch has a yen shortfall from a large client payment. Tokyo needs to settle a maturing FX swap. The far leg is due today, meaning you're delivering dollars and receiving yen. 7 a.m. Europe opens. Your Frankfurt desk has euro payments queuing for target 2. Your London desk has sterling settlements going through chaps. New York isn't awake yet, but you already know you have a $200 million chips payment due at 5 p.m. Eastern. 8 a.m. CLS settlement window opens. For the next 5 hours, the bulk of your FX settlement flows will concentrate here. 18 currencies, payment versus payment. Billions in gross flows, netting down to much smaller net positions. But those net positions still need funding, in real time, in the right currencies. 10 a.m. Your cash management team gives you the daily forecast. Net position by currency, by payment system, by hour. You're long euros, short dollars, flat sterling, and have a small yen gap. The dollar shortfall is 400 million, but it's temporary. A large dollar receipt expected at 3 p.m. from a corporate client. What do you do with those 7 hours? You execute overnight swaps, sell euros, buy dollars, cover the gap. When the dollar receipt arrives, you reverse the position. Cost, a fraction of a pip. Problem solved. That's liquidity management, repeated across dozens of currencies every single day. Now let me talk about the regulatory framework. Because since 2008, liquidity isn't just an operational concern, it's a regulatory requirement. Basel III introduced 2 quantitative liquidity standards. The liquidity coverage ratio, LCR, banks must hold enough high-quality liquid assets to cover 30 days of net cash outflows under a stress scenario, minimum ratio, 100%. Most banks target 120 to 150% for headroom. What counts as high quality? 3 tiers. Level 1, government bonds, central bank reserves, no haircut, unlimited. Level 2, A, agency securities, covered bonds. 15% haircut, capped at 40% of total. Level 2B, corporate bonds, certain equities, 50% haircut, capped at 15%. The tiering reflects how easily assets convert to cash during a crisis. The net stable funding ratio, NSFR. This addresses the structural question over a 1-year horizon. Do you have stable enough funding for your assets? Retail deposits get 90 to 95% credit, they're sticky. Short-term wholesale funding, much less. The NSFR forces banks to match asset duration with appropriately stable funding. These ratios shape behavior. Banks hold larger liquid asset buffers. They prefer term funding over overnight rolls. They actively manage their funding mix to optimize regulatory metrics, especially at quarter-end and year-end reporting dates. And this creates market effects we discussed in episode 14. Quarter-end swap point widening, year-end liquidity hoarding, predictable patterns that smart treasury teams plan around. Let me talk about the corporate treasurer's version of this challenge, because it's different from a bank, but no less demanding. A multinational corporation operating in 15 countries has cash flows in a dozen currencies, receivables landing at unpredictable times, payroll going out on fixed dates, tax payments, intercompany transfers, dividend remittances, debt service. The treasury team needs to ensure that every entity has enough cash in the right currency at the right time. Too much cash sitting idle is wasteful. It could be invested or used to pay down debt. Too little creates operational risk. Miss a payment and you've got a problem. The core tool is the daily cash position report. Every subsidiary reports its cash balances and expected flows. Treasury aggregates these across currencies and entities, identifies surpluses and deficits, and then deploys the toolkit. Surplus euros in Germany, deficit dollars in the US, execute an overnight Euro-USD swap, surplus sterling in London, deficit yen in Tokyo, another swap. Cash pooling structures concentrate balances at the parent level for central deployment. Notional pooling offsets balances across entities without physical movement. The efficiency gains from active multi-currency management are substantial. A company with $1 billion in aggregate cash across 15 entities might need $500 million in total if managed centrally, versus $800 million if each entity holds its own buffer. That $300 million freed up can reduce debt or generate returns. Now, let me get specific about the toolkit, the instruments corporate treasurers use for day-to-day liquidity management. FX swaps. We've covered these extensively. For daily liquidity purposes, overnight and Tom Neck swaps are the workhorses. Convert surplus currency into needed currency. Reverse the next day. Cost measured in fractions of a pip for major pairs. This is the cheapest, most flexible tool in the box. But here's a practical tip. Don't always default to overnight. If you know you'll need dollar funding for a week, do a 1-week swap. You'll avoid executing and settling 5 separate overnight swaps. Slightly wider pricing, but operationally simpler and cheaper when you factor in the full cost of daily settlement processing. Money market instruments, treasury bills, commercial paper, certificates of deposit. These are where you park surplus cash for periods of days to months. The choice depends on credit quality, liquidity, and yield. T-bills offer the highest liquidity and lowest risk, but typically the lowest yield. Commercial paper from high-grade corporates offers better returns but less secondary market liquidity. For treasurers managing large pools, money market funds provide diversified exposure with daily liquidity. But since 2008, regulatory changes have introduced gates and fees during stress. The ability to withdraw may be restricted precisely when you need it most. Repo, sale and repurchase agreements. You sell a security today and agree to buy it back tomorrow at a slightly higher price. The difference is the repo rate, essentially the cost of overnight secured borrowing. If you hold government bonds as part of your HQLA buffer, you can repo them overnight to raise cash without selling them outright. When the cash need passes, the repo unwinds and your bonds return. This is collateral transformation, converting an asset you hold into the cash you need, temporarily at low cost. The cost for treasury repo is typically 3 to 5 basis points below unsecured rates. But it requires the operational infrastructure to manage collateral custody, margining, legal documentation. Credit facilities, revolving credit lines from relationship banks, expensive to maintain. You pay a commitment fee, typically 25 to 50 basis points annually, whether you use the line or not. But they provide committed funding when markets close. During March 2020, companies drew record amounts from revolving facilities as a precautionary measure. Having the line in place before you need it is essential. The key insight: you don't optimize for any single instrument. You build a toolkit. Swaps for daily management, money markets for short-term investment, repo for secured borrowing, credit lines for contingency. Each instrument serves a different purpose and performs differently under stress. Let me talk about intraday liquidity, because this is an area most podcasts never touch, and it's where things actually go wrong. Every payment system has cut-off times. Chaps in London closes for same-day sterling payments at a specific time. Chips in New York has a 5 p.m. Eastern deadline for dollar payments. Target 2 in Frankfurt has Euro cut-off times. CLS has a concentrated 5-hour settlement window in the morning European hours. If you miss a cut-off, the payment doesn't settle today. It fails. The counterparty doesn't receive their money. They may miss their own obligations as a result. A chain of failed payments cascades through the system. Managing intraday liquidity means predicting, hour by hour, what your position will be in each currency across each payment system. When are the large outflows? When do the inflows arrive? Is there a gap where you're temporarily short? Central banks provide intraday credit facilities to bridge these gaps. The Fed allows daylight overdrafts on Fedwire. You can go negative during the day as long as you're back to zero by close. The ECB provides automatic intraday liquidity through Target 2 against pledged collateral. But relying on intraday credit has costs. The Fed charges for daylight overdrafts based on peak usage. The ECB requires collateral that could otherwise be deployed elsewhere. Smart treasurers minimize intraday credit usage by sequencing payments, putting outflows later in the day after inflows have arrived, netting where possible. Timing large transfers to coincide with expected receipts. Machine learning is starting to help here. Algorithms trained on historical payment patterns can predict daily flows with accuracy within 10 to 15% for aggregate positions. That's enough to pre-position liquidity before the day starts, reducing surprises and minimizing the need for emergency intraday adjustments. Finally, let me talk about stress testing, because everything I've described works beautifully in normal markets. What about when it doesn't? A comprehensive stress test asks, what happens if multiple things go wrong simultaneously? Firm-specific shock. Your credit rating gets downgraded. Depositors pull funds. Counterparties reduce credit lines. You lose access to unsecured funding. Market shock. The cross-currency basis spikes. Swap funding costs double. Money market funds gate redemptions. Repo haircuts increase. Even secured funding becomes expensive. Combined scenario. Both happen at once. Because in a real crisis, they always do. Your downgrade happens because of the same market stress that's closing funding channels. It's not two separate problems, it's one problem with two dimensions. March 2020 provided the most recent calibration point. The EUR/USD basis hit negative 120 basis points. Money market funds experienced significant outflows. Commercial paper markets froze. Companies drew revolving credit facilities preemptively, all within 2 weeks. A well-designed contingency funding plan has escalation levels. Early warning, enhanced monitoring, no action changes. Moderate stress. Extend funding tenors, reduce new lending, pause buybacks. Severe stress. Draw credit facilities, access central bank operations, begin asset liquidation if necessary. The key is having these responses pre-agreed and pre-authorized. During a crisis, you don't have time for committee meetings. The board should have already approved the triggers and the responses. The treasurer just executes the playbook. That wraps up part 4. FX swaps. 4 episodes. From the basic structure of near and far legs, through bank funding and the cross-currency basis, into central bank operations and swap lines, to the daily reality of liquidity management. These 4 episodes covered the most traded instrument in currency markets and the one that most finance education ignores. If you understand swaps, you understand how the global financial system is actually plumbed. Next episode, we start part 5, the final section of this series, NDFs and emerging markets, non-deliverable forwards. The instruments that let you hedge currencies where physical delivery is impossible. $100 billion a day in markets most textbooks don't even mention. I can't wait. This is The Trading Floor. I'm David Axtell. FX Cash Products by Luigi Rondinini and myself is now available through all major marketplaces and directly from rondinini.com. The liquidity management chapter covers LCR and NSFR calculations, intraday cash positioning, collateral transformation, and stress testing frameworks. The kind of practical detail you need to actually run a treasury operation. For more depth, visit learn.rondinini.com. 122 professional mini-manuals covering every aspect of FX markets, treasury operations, and risk management. Plus, production-ready Python toolkits for liquidity forecasting, cash position optimization, and regulatory ratio calculation. For corporate treasury teams needing hands-on help with liquidity frameworks, system selection, or risk management strategy, Luigi provides consultancy through rondinini.net. And for institutions looking for FX and treasury expertise, market structure, counterparty management, building out your operations, I'm available through axtellconsulting.net. See you in episode 17.